$89. I said it. I called 89 on January 15th when everyone was losing their minds at 117. You know what happened 48 hours ago? We hit $77.90. A 33% implosion in less than 24 hours. The biggest single-day collapse in silver's history. And if you're sitting there right now wondering whether you just watched your stack get cut in half, or whether this is the buying opportunity of a lifetime, you need to hear what I'm about to tell you. Because what happened on January 30th wasn't random. It wasn't market forces. And it definitely wasn't over. Here's what nobody's talking about. While paper silver was getting murdered on the COMEX, something absolutely insane was happening in Shanghai. The physical premium exploded to plus 29%. Let that sink in for a second. The Shanghai Gold Exchange was trading silver at a 29% premium over COMEX spot after the crash. According to data published February 2nd by Jensen David's Substack, Chinese buyers were paying the equivalent of $103 per ounce, while Americans were panic selling paper contracts at $78. That's not a market. That's two completely different assets wearing the same name. You want to know the real story? Kevin Warsh. On January 30th, Trump nominated Kevin Warsh as the next Federal Reserve chair. The guy's a hawk. Markets immediately priced in higher for longer interest rates. The dollar spiked, and algorithmic selling programs went berserk. But here's the thing that's driving me crazy. That announcement came at 3:45 p.m. Eastern. Silver had already dropped 18% before the news even hit. The CME Group had raised margin requirements twice in 3 days, leading up to that Friday. They knew exactly what they were doing. Force leveraged speculators to liquidate, trigger stop losses, create a cascade, then drop the Warsh news as the cherry on top. Now let me be brutally honest with you for a second. I could be completely wrong about what comes next. If we break below 75 and hold there for more than 3 trading days, this entire thesis falls apart. The bulls are done. We're going back to test 60, maybe even 50. JP Morgan put out a note saying silver could collapse to $50 within 6 months. They called the recent rally a speculative bubble. And you know what? They might be right. The speed of that move from 40 to 117 was absolutely parabolic. That kind of price action doesn't happen in healthy markets. It happens in mania, and manias end badly. But here's where it gets interesting. Pull up a chart right now. I'm serious. Open TradingView or whatever platform you use. Look at the February COMEX contract volume on January 30. According to bar chart data, as of February 3rd, open interest on the February contract dropped to just 1,231 contracts. That's a 92% decline from 2 weeks prior. You know what that tells me? Weak hands are gone. Retail got flushed. The tourist who bought silver at 110 because their cousin told them it was going to 200, they're out, they sold at a loss, they're never coming back. And that's exactly what had to happen before the next leg up. Here's a number that should terrify anyone shorting silver right now. 113.27 million ounces. That's the registered COMEX inventory as of January 26th, according to data cited by investing.com on January 29th. Registered inventory is the silver that's actually available for delivery against futures contracts. We've lost over 70% of registered silver since 2020. 70%. And March deliveries start in 10 days. On January 30th, the settlement price for February contracts was $78.29. 2 days later, spot is trading at 84. If you're holding a short position right now, you're either going to have to deliver physical silver that doesn't exist at these warehouses, or you're going to have to buy back your contract at whatever price the market demands. Let me tell you a story. January 15th, 2026. I'm on the phone with a dealer I've known for 8 years. Guy moves serious volume. I ask him what premiums look like. He laughs. Not a happy laugh. A stressed laugh. He tells me he's got a 3-week backlog on American Silver Eagles. 3 weeks. His distributor can't get product. The mint is rationed. And this is at $100 silver. You know what that means? When spot was screaming higher, the physical market was already breaking. Now we're at 78 spot. And according to SD Bullion's February 2nd update, retail demand has gone vertical. Everyone who missed the move up is trying to back up the truck at 78. Except dealers aren't dropping premiums, they're raising them. Because they can't replace inventory. Stop. Let me ask you something honestly. Do you actually understand what's happening here? Because I'm not sure I do. And I've been watching these markets for 15 years. This isn't normal price discovery. Normal markets have supply and demand curves that intersect. When price goes down, demand falls, supply catches up, equilibrium gets restored. That's not what's happening with silver. Price crashed 30%, and physical demand exploded. That's not a market, that's a warning sign. The dollar index hit 97.4 on February 4th. That's down from 99 in late December. The Fed held rates steady at 3.5 to 3.75% on January 28th, but two governors dissented. They wanted a cut. The market's pricing in 2 rate cuts by year-end. If Powell pivots and Warsh doesn't get confirmed, or if Trump overrules him, the dollar's going lower. And when the dollar falls, commodities rip, especially silver. Especially silver, that's in a structural supply deficit. Here's the contrarian take that's going to get me hate comments. Maybe the crash was healthy. Maybe we needed to flush out the gamblers, because the fundamental case for silver hasn't changed one bit. According to the Silver Institute data widely reported in Q4 2025, industrial demand is still growing, solar panel production, EV components, 5G infrastructure. None of that stopped because silver went from 117 to 78. In fact, lower prices make industrial buyers more aggressive. They're going to lock in supply. And when they do, that registered inventory number I mentioned, it's going to drain even faster. The gold to silver ratio is sitting at 60 as of January 31st, according to long-term trends data. Historically, when that ratio gets below 60, silver is considered expensive relative to gold. But here's the thing, we hit a low of 53 in mid-January. That was the lowest ratio since 2011. And you know what happened in 2011? Silver hit $50, then crashed to 26 within weeks. Same pattern. Parabolic move, ratio compression, violent correction. The difference is, in 2011, there was no structural supply deficit. There was no green energy revolution. There was no China export licensing system restricting silver flows. And there definitely wasn't a Shanghai premium of 29% signaling that physical and paper had completely decoupled. China implemented new export restrictions on silver, effective January 1, 2026. You want to buy silver from China now? You need a license. And guess what? They're not handing out licenses to just anyone. According to multiple reports from late January, the Shanghai premium hit as high as $14 per ounce before the crash. After the crash, it went to 29. That means Chinese buyers don't care what the COMEX says. They can't get metal, they'll pay whatever it takes. And that premium is going to arbitrage itself eventually. Either COMEX prices rise to meet Shanghai, or Shanghai stops buying COMEX contracts and the whole pricing mechanism collapses. Let me hit you with another data point that's absolutely wild. The iShares Silver Trust, ticker SLV, saw $2.9 billion in outflows during January, according to Yahoo Finance data published February 3rd. Retail investors panic sold. But you know what's crazy? During the same period in mid-January, SLV had record inflows. $397 million on January 15th alone, according to ETF Channel. So retail bought the top, then sold the crash. Textbook. And institutions? They're not in SLV, they're in allocated accounts. They're in private vaults. They're buying physical and taking delivery. And they're not selling. Here's what I'm watching for the next 72 hours. If we hold above 77, this is a bear trap. The algorithms and the margin hikes flushed out the weak hands, but the structural buyers are stepping in. We should see a grind back to 85, maybe 90 by mid-February. If we break 77 and close below it for 2 consecutive days, I'm wrong. The JP Morgan bears were right. We're headed to a retest of 60 or lower. But if we hold and start making higher lows, buckle up, because the next move higher is going to be even more violent than the first one. And this time, there won't be any paper silver left to sell. You want to know why I'm still bullish despite the carnage? It's simple. The February 26th COMEX contract delivery date. March deliveries. If open interest stays elevated and registered inventory stays depressed, someone's going to default. Or someone's going to pay a massive premium to source physical. Either way, that's bullish. The market's going to realize that COMEX can't deliver. And when that happens, the entire pricing mechanism breaks. We saw a taste of it with the Shanghai premium. Imagine that going global. So here's the framework. 77 is your line in the sand. Above that, we're in accumulation. Below that, we're in distribution. Watch the dollar index. If DXY breaks below 96 and holds, metals catch a bid. Watch the 10-year Treasury yield. If yields roll over, rate cut expectations rise, and that's rocket fuel for silver. Watch COMEX registered inventory. If that number drops below 100 million ounces before March deliveries, it's game over for the shorts. And most importantly, watch Shanghai. If that premium stays elevated or widens further, it confirms the decoupling thesis. The mainstream narrative is that silver crashed because of Warsh, because of margin hikes, because of profit taking. And yeah, those are all true on the surface. But the real story is that the paper market broke. It broke because there's not enough physical silver to satisfy demand at these prices. And the only way to suppress price in a broken market is to create a panic. Flush out the weak hands. Make retail think the bull market is over. Make them sell at a loss. Then quietly accumulate while everyone's scared. I've been stacking since 2012. I've seen silver at 14 bucks. I've seen it at 50. I've seen crashes that made January 30th look like a Tuesday. And I'm telling you right now, this feels different. The fundamentals are stronger than they've ever been. The supply deficit is real. The industrial demand is real. The geopolitical chaos is real. The only thing that's not real is the paper price. And eventually reality wins. You're not going to get a perfect entry. You're not going to time the absolute bottom. But if you believe that silver is money, that fiat currencies are in trouble, and that industrial demand is going to keep growing, then anywhere below 90 is a gift. Anywhere below 80 is generational. And if we touch 70, you back up the truck. March deliveries are in 10 days. The next Fed meeting is March 18th. Trump's going to keep tweeting about the dollar. China's going to keep restricting exports. And the COMEX is going to keep pretending there's enough silver to go around. Something's going to break. The only question is whether you're positioned when it does. I'll be tracking this daily. Next video drops in 48 hours with updated delivery data and premium spreads. If you're in this for the long haul, you already know what to do. If you're trading it, good luck. You're going to need it. Because this market doesn't care about technical analysis anymore. It cares about who's holding physical and who's holding paper. And when the music stops, only one of those is going to matter. 77 or retest, comment your prediction. No essays. Just the number. And if you've been stacking since before 2020, drop an old-timer emoji. If you bought your first silver after the crash, drop a rookie. Let's see where everyone stands. This isn't financial advice. This is a front row seat to the most insane silver market in history, and we're just getting started.